This millennial is trying to move out of his parents' basement and buy his very first home. The only problem is he's not familiar with mortgages and doesn't know how to go about choosing one. And so we're gonna help him out today. I picked out 4 different mortgages that are available to almost everyone. We'll go through each mortgage, discuss the pros and cons of each, and then can jump into Microsoft Excel to see which of these 4 mortgages are going to save this millennial dinosaur the most money. Ready to get started? Let's get it! Alright, in the previous video, we used this cool 90s rug to help describe the overall home buying process. We currently are still in the mortgage selection category, and we left off talking about the difference between conventional and unconventional loans. This first category will be for conventional mortgages, and in case you missed it from the previous video, I'll just give you a quick summary as to how these mortgages work. A conventional mortgage is going to be your traditional loan you get from either your bank, credit union, or mortgage lender. They are not insured by the government, meaning the lender assumes all the risk of potentially not being paid back by the borrower. The good thing about these mortgages are they tend to have lower overall costs than unconventional mortgages. The bad thing, however, is usually you need a better credit score to qualify and have to have a larger down payment. If you want more info on this, then check out the previous video in part 4. So now that we're up to date on conventional mortgages, let's jump over to Microsoft Excel and I can show you how much this type of loan is going to cost you over a 15-year period. So the median home price at the time of making this video was just under $405,000. So to keep this simple, let's just plug in $400,000 for the home we're looking to buy. Likewise, the average annual interest rate for 15-year mortgages is currently 2.39%. So we'll plug that into our formula. And to keep this problem simple, let's assume we're not including property taxes, homeowners insurance, or HOA fees. And so now we want to figure out how much in total this conventional mortgage is going to cost us. Typically, the down payment for these types of mortgages will be 20%, so you don't have to worry about paying private mortgage insurance on top of your mortgage payment each month. So that means we'll have to pay $80,000 for our down payment, and then we will borrow $320,000 from our bank or mortgage lender. Well, if we want to pay off the loan in 15 years, then our monthly payment would be $2,117 per month. Meaning over the life of this loan, we would have paid over $61,000 in total interest. And when we include our down payment, this $400,000 home is really going to cost us over $461,000. And you're probably thinking, wow, a conventional loan sounds way too expensive and is probably not the right fit for our friend here. But not so fast. I summarized all the key points in this chart here, so we'll have to come back in a little bit so we can compare the remaining 3 loans. So now that we have our conventional loan out of the way, let's take a look at our unconventional loans. These types of loans are insured by the government, meaning in the event that you default on your loan, the government agrees to repay a portion of your debt to the lender. The first type of unconventional loan is called an FHA loan. FHA stands for Federal Housing Association, which is the government agency that insures mortgages for home buyers. Usually, if you have a hard time getting approved for a conventional loan, then FHA loans are your next best bet, as you can get a mortgage with a significantly less down payment and are available to people who have less than stellar credit scores. The downside to FHA loans, however, is you will be required to pay both a monthly and annual mortgage insurance premium. And to give you a better idea of what type of insurance this is, let me show you an example real quick. In the event that you default on your mortgage payments, the lender will repossess your house, and then the Federal Housing Association will use the money funded by the mortgage insurance premium to pay the lender the remaining balance of your mortgage in exchange for ownership of the house. So the premium basically protects the lender from borrowers who have a higher chance of defaulting on their loans. And if you want to see how all these numbers play out, let's jump into Microsoft Excel and we can compare the FHA loan to the conventional loan. Alright, so same as the earlier problem, we are looking to buy a home for $400,000. For the sake of this problem, we'll keep the annual interest rate the same, although in reality, usually when you're taking out an FHA loan, you are considered a riskier borrower, so your interest rate should be higher. But for the sake of this problem, we'll keep the interest rate the same. And since we can't do the 20% down payment with the conventional loan, we're going to do the minimum down payment with the FHA loan, which is 3.5%. Meaning we need to borrow $386,000 from the bank. In order to repay our mortgage within 15 years, our monthly mortgage payment that goes towards principal and interest will be $2,554. And because this is an FHA loan, we will have to pay an upfront fee as well as a monthly insurance payment. And to save time, I've summarized all the important information here. We can see that by going with an FHA loan, our millennial dinosaur friend will have to pay over $523,000 in total in order to buy that $400,000 house. And so between the two different types of mortgages, the conventional mortgage is gonna be the cheapest so far. But let's keep moving. We still have two other loans to talk about, which might be more affordable for our millennial friend. Alright, the next type of unconventional loan we're going to discuss is the VA loan. For those that are not familiar with the VA, this stands for Veterans Affairs and is the department of government that is responsible for helping military service members integrate back into society. Usually they deal with different types of benefits that range from healthcare to education and even life insurance. In terms of buying a home, they offer military members and their families the ability to take out a mortgage by putting 0% towards the down payment. The way this works is similar to an FHA loan. You'll have to take out a loan from a bank, credit union, or mortgage lender. The VA will guarantee this loan, meaning in the event that you're not able to repay the lender, the VA agrees to step in and repay a portion of the debt that you owe. Now, I'm not going to get into all the specifics of the VA loan, but just know there are a few advantages and disadvantages of using this type of loan. Aside from not being required to make a down payment, the VA loan also does not require private mortgage insurance, which means your monthly mortgage payment will not be as expensive. The VA also offers assistance to home buyers in any case where they are struggling to make their mortgage payments. Some of the disadvantages of using this type of loan are you cannot use the loan to buy an investment property or a vacation home. There is also a funding fee which you will be required to pay either as an upfront expense or you can have it financed in with your mortgage. The purpose of the funding fee is to help lower the cost to taxpayers, as it looks like they are the ones that are helping fund this program. And so jumping back into Excel, let's see how much the VA loan is going to cost us in total for buying a $400,000 home. Let's assume that the 15-year fixed interest rate remains the same for this type of mortgage. And since this is a VA loan, we will not be required to make a down payment, meaning we will be buying a house with 100% financing. Since this type of loan requires a funding fee, we're going to have to pay $9,100 on top of our original loan amount. That means in total, we will be borrowing just over $409,000 from our bank or mortgage lender. That brings our monthly mortgage payment to $2,707 per month. I've summarized all the important information in the chart on the screen. And right off the bat, we can see that the VA loan is going to be the most expensive mortgage option so far, with our overall interest payments being just over $17,000 more than the overall interest payments on a conventional mortgage. However, when we include the down payment and insurance on the home, the VA loan is still going to be a cheaper option than using an FHA loan. And that brings us to our last type of mortgage, which is a USDA loan. In case you're wondering, USDA stands for United States Department of Agriculture. So can you guess if this is a government-backed loan? Yep, you betcha. The USDA loan program is an unconventional loan that is designed to improve the economy and quality of life in rural America. It primarily targets low-income families that are unable to obtain a conventional mortgage. And despite having agriculture in the name, no, you do not need to be a farmer to qualify. One of the great things about a USDA loan is you can borrow up to 100% of the home's appraised value. And in the event you purchase an undervalued home, you can use the loan difference between the home's appraisal price and purchase price to put that money towards closing costs or expenses for things like repairs. Similar to the VA loan, the USDA loan does not require private mortgage insurance. They instead will require you to pay for two different forms of mortgage insurance. One is an upfront fee known as the USDA funding fee, and the other fee would be equivalent to a mortgage insurance premium, which was discussed with the FHA loans. Both of these fees are used to help keep the USDA loan program afloat, so taxpayers don't have to pay for losses from this program. And so jumping back into Excel, let's use the same criteria from before to see how expensive this loan will be for our millennial dinosaur friend. We'll assume it's still a $400,000 house that we want to purchase, and the 15-year fixed interest rate remains the same as before. Since there is a funding fee required for the USDA loan, we will include that in with our overall mortgage. So overall, we will be borrowing $404,000. And since there is no down payment required for this type of loan, in order to pay this off within 15 years, our monthly mortgage payment will be $2,673 per month. A summary of all the important information about this loan can be seen on the screen. We can see that when you include the mortgage insurance and funding fee that this loan requires, we will be paying over $25,000 on top of the original amount of money we borrowed. Based on these four different types of mortgages, we have one conventional loan and then three unconventional loans. If we were to rank these mortgages in order based on the amount of interest we will have to pay in total, then a conventional mortgage would be the cheapest, while the VA loan would be the most expensive. However, looking at the big picture, when we include the down payment, mortgage insurance, and funding fees that are associated with these different mortgages, then that would mean that the conventional loan would still be the best option, while the FHA loan would be the worst option. So giving our millennial friend some advice, if he is looking to buy a $400,000 home then the cheapest way to do that is to save up for a 20% down payment and go with the conventional mortgage option. The other 3 loans sound enticing because of the low down payments, but after you factor in all the different fees and mortgage insurance, you could be overpaying on the total cost of your home by over $26,000.